What's up guys, Demon Docs here. Sorry, this YouTube video is gonna be a little bit late compared to that we typically update every single week. So today we're gonna talk about how to really scan for stocks, and I see a lot of people asking, well, how does day traders really try to find the ticker, what they're supposed to trade on the current day? Today I'm gonna give you a couple criteria, take it and use it. It's very simple. So it should help you narrow it down which stock to trade, and to also help you not to over trade that much. All right, so the first thing is, typically what I do is I look at top percent gainer on your platform. There's a couple platforms I recommend. There's eTrade Pro, there's Interactive Broker, there's TradeZero platform. There's all kinds of platforms, Dash Trader platform, you can choose whatever you want, Equity Feed, and all that. Once you find that, and you basically want to select either on NASDAQ or New York Exchange to find what is the toppest percent gainers. And you kind of want to find anywhere between around 20% or above. Sometimes you can see the stock are up around 10,000%, 20,000%, but with no volume. And you can kind of instantly realize that the stock did a reverse split. We're gonna get into reverse split a little bit later because that's gonna be a little bit longer to explain. Typically what I scan for is the stock is under 200% or above 20%. In that range, you wanna find a stock that fits your pattern and also meet your criteria as well to be able to place a trade. So the first thing is pre-market volume. Super important, anywhere above 100,000, because if the volume is too low in the pre-market, the stock gets really thin and you don't really have an idea how much volume is going to trade right after open. Most of the time, the stock is going to trade really thin volume anywhere under 4 million, which is very, very difficult to execute trades. Second, so the flow. Flow is very important, supply and demand, we all know that. The lower the supply, the higher the demand. The higher the supply, the lower the demand. And that will affect the stock price. And if there's too much demand and there's only limited amount of supply, the stock will go up. And if there's too much supply and the demand will go down, that will decrease the stock price. So that's why you can see sometimes low flow will increase significantly compared to higher flow. There is a specific range of flow that I typically don't trade, is between 0 to 2 million. So if the flow is under 2 million, it's very easy to manipulate. That's number one. Number two, it's most of the time when they're on low flow, the volatility jumps back and forth with really big range compared to other stocks that have a little bit bigger flow. And it's really hard to execute trades and to find your ideal entry. Let's say you want to execute at 7.5, and on those lower flow, you can probably get executed at 7.30. So that's 20 cents difference compared to what you want to execute in the higher flow, especially when you're using market orders. Number three, the market cap. We all know if the market cap is too big, let's say it's a $1 billion market cap, it's not gonna go over 1,000% because they need so much money to really move the $1 billion market cap. Now, if the stock is under, let's say 100 million, 200 million, then it has a chance to go over 100% because there is a possibility that stock will bring 100 million to 200 million into the market cap on the current day. You don't really see that often. So most of the time, the stock jumps around 200%, 200% is anywhere between 0 to 100 million. That's where you consider into like a mid cap or small cap zone. You can trade. A comfortable range is around, I would say, 0 to 200 million. Anywhere above that, I don't really feel comfortable to trade, especially on parabolic. Now, also, there's crowded trades. As I talked about, if the trades gets super low volume, and it's basically not really tradable. But there's another scenario that if the stock trades too much volume and it will get crowded. Once stock gets crowded, think about like this way. So if there's an industry and there's so many people trying to go in and make money, there's too many people getting in at the same time, you will increase the competition. And once you increase the competition, it's really hard for you to make money. So if the stock is super crowded, it's the same idea. It's very difficult to make money. So that's why when the stock is super crowded, I tend to stay away. That will be the 3 criteria for today, and hopefully you find this helpful. Take some notes, and thank you very much for watching this video, and I'll see you guys next week.